So this deep dive starts with a genuine surprise. We're looking at a stack of sources that were, frankly, betting on market chaos.
Absolutely. They were braced for continued recession fears deep into 2025.
And then the results released on December 19th just completely changed the game.
Flip the narrative on a dime.
So our mission today is to unpack that, to look at what happens when a market braces for disaster but gets something else entirely. We'll start with that massive macro event, then zoom in on why it was such a green light for digital finance and one company in particular.
Right.
If you're trying to understand how these big shifts connect to a specific stock story, this is the deep dive for you. Okay, let's unpack this.
It's just, it's not often you see a single data release carry so much weight. I mean, psychologically, these sources, they really captured a moment where all this uncertainty was just replaced by this sudden momentum.
And for 2 years, the story was inflation.
Right.
Just inflation and fear.
Exactly. Fear of how high the Fed would hike rates. But December 19th wasn't just another data point. It was the pivot. The conversation shifted, irrevocably from inflation concern to, okay, when are the rate cuts coming?
And that's the foundation for this whole thing.
That shift is the bedrock.
So let's detail this turning point. We're talking about the CPI report, the Consumer Price Index. It drops on December 19th, 2025. And the sources don't just say the numbers were good. They say they were shockingly better than expected.
And to get that shock, you have to remember the atmosphere. Heading into that report, the consensus was for, what, a modest cooling?
Right, like a 0.1% drop, maybe?
Yeah.
Everyone was nervous about sticky components, housing, services, anything that would let the Fed stay higher for longer.
And this report just blew those expectations out of the water. It wasn't one thing. It was broad-based cooling. It suggested the hikes had finally, worked their way through the system.
So what does a number like that do immediately?
Well, it does two things the market had been craving. First, it kills that narrative of runaway inflation, just kills it dead.
And second,
It lets investors take back control of the narrative. That's maybe the most important part. They're not reacting to fear anymore. They're reacting to possibility.
If we connect this to the bigger picture then,
The conversation about monetary policy just fundamentally changes. Before this, any talk of rate cuts was tentative, full of cautious Fed speak.
always, we need to see more data.
Exactly. After December 19th, it immediately shifted to rate cuts. The question was no longer if, it was when and how fast.
And the sources get into the politics of it too, which I found interesting. They basically say the momentum is all one way now, toward easing.
Right, regardless of whether the Fed wants to be sticky.
So why does that matter so much?
It matters because the sources argue that the trend is set. Whether the Fed acts purely on the data or whether, political pressure forces their hand going into 2026, the outcome is the same.
A lower cost of capital.
A much, much easier macro environment in 2026. And that confidence, that shift, underpins everything else we're about to talk about.
It's like it broke a psychological barrier.
It did. Think about it. For years, good news was bad news. Bad news was bad news.
A recession, yeah.
This was the golden scenario. Inflation cools, but the job market doesn't collapse. It's the soft landing. That's the green light. That's the signal to start pricing in expansion, not contraction.
So if the market gets this green light, how fast does that translate to specific sectors?
Almost instantly.
Which brings us to the sector setup. We go from this global macro surprise to a really specific idea. The sources are just dead certain.
Unequivocal.
They call it the perfect setup for bank stocks. And among those, they point to SOFI as the star of the show.
And it's really crucial for you, the listener, to understand the mechanics here. Why a company like SOFI?
Right. Why a digital bank over, say, an industrial giant?
It's all about their cost of capital and their lending business. During the hike cycle, their funding costs were going up. For a fintech focused on personal and student loans, high rates can, kill demand and squeeze your margins.
There's a headwind.
A massive headwind. Now, with cuts on the table, two things happen. First, their cost of funds drops, which widens their profit margin on loans. And second, consumer demand for refinancing, for new loans. It just explodes when rates go down.
There's a double boost.
It's a double boost to their core business. It's the difference between fighting uphill and having the wind at your back.
And that explains the conviction. I mean, the author says they are incredibly bullish and that anything under $30 is a gift. That's aggressive.
It is aggressive, but that price target isn't just because of the CPI report.
No.
The CPI report just removes the biggest external problem. The conviction comes from believing the company's internal growth is about to meet this perfect macro backdrop.
So it's the synthesis. The fundamentals were already there. And now the world has stopped fighting them.
That's it exactly. The sources are saying don't get distracted by short-term noise because the company is still building, still growing, and still hitting every milestone.
So they see 2026 as the year it all comes together. The growth that was kind of held back by high rates finally gets to run free.
Yes, and that $30 valuation, it's built on an assumption that SoFi hits a critical mass of profitability and member growth, and that the market will value those achievements much higher because the big systemic risk inflation is off the table.
So the CPI report was the final piece of the puzzle. The thing that confirms 2026 is going to be a banging year for SoFi.
It's the external endorsement for the long-term story.
Okay, so let's transition from that favorable setup to the specific internal catalysts that are really fueling this case. The sources point to three main drivers for 2026.
Right.
The first one is just the broader Q4 earnings context.
Yeah.
We expect the Magnificent Seven to crush it, but for SoFi, the focus is more about its own proprietary growth.
Which leads right into the second driver, what the source calls the billion-dollar position. We need to clarify that for listeners.
Yeah, what does that actually mean?
When they say that, they're likely talking about a key balance sheet milestone, specifically hitting $1 billion in total stockholders' equity.
And that's not just a big number for show.
No, not at all. For a regulated bank, hitting capital levels like this is a massive deal. It signals financial strength. It can open doors for new regulatory approvals.
Like paying a dividend, maybe way down the road.
Potentially. But more importantly, it proves to big institutional investors that you've graduated. You're past the risky startup phase. You have the balance sheet to handle a downturn.
So it's an internal checkpoint. It says, we are a real stable bank now.
Exactly. It validates the entire foundation. But even with that and the macro win at their back, the single biggest catalyst is S&P 500 inclusion.
This is the big one.
This is the one that promises to unlock value on a whole different level.
And the sources are so definitive. They say it's no longer a matter of if SoFi gets added to the S&P 500, it's a matter of when. They treat it like it's a done deal.
What's fascinating here is that certainty. It implies they believe the company has already cleared the hurdles set by the S&P committee.
Which are pretty strict, right? You need sustained GAAP profitability.
Very strict. You need the most recent quarter to be profitable and the sum of the last 4 quarters to be profitable. Achieving that, while still growing like they are, is what turns you from a tech stock into a blue chip holding.
Okay, but hold on, let's push back a little. If everyone is so sure this is going to happen, isn't there a risk that it's already priced in?
That is the essential question. The timing risk is real. But the sources argue that while the idea might be priced in, the mechanical reality of inclusion is not.
The forced buying.
The forced buying. The real move happens right after the announcement.
So let's get into the mechanics of that. The sources use some pretty vivid language here. They say when the announcement hits, the floodgates open.
And for you listening, it's so important to understand why. It's not about sentiment. It's a forced buying mechanism.
Okay, explain that.
Think about all the money in index funds and ETFs that track the S&P 500. We're talking trillions of dollars.
Right.
When the committee adds a new stock, every single one of those funds has to buy it. They are forced to buy it to match the index. It doesn't matter what the price is.
They have to, or they risk tracking error.
Precisely. This isn't retail hype or an analyst upgrade. This is mandated institutional capital that has to flow into the stock over a very short period.
And that creates what the source calls leapfrog moments.
Yes, where the share price just runs because there's way more demand than available supply in that crucial window between the announcement and when it officially joins.
And this isn't just a theory, right? There's history here.
Oh, yeah. They say they have seen what happens to companies after they join the S&P. The growth can be monumental. It can permanently re-rate a company's valuation.
It's the ultimate institutional stamp of approval.
It is. Suddenly, you're on every major fund's radar. Liquidity goes up, volatility often goes down. You're viewed as a much safer, more established company.
So the action item here, if you're following this logic, is really about the long-term payoff. It's for people who have been buying the lows and building positions.
It's a strategy of patience. The CPI news removed the big macro hurdle. Now, S&P inclusion provides the clearest, biggest catalyst for a price move that is almost guaranteed to happen.
Right. So what does this all mean? The takeaways are pretty clear. You have the CPI surprise on December 19, 2025, which flips the whole script on rate cuts.
The green light.
That acts as a green light for bank stocks, and specifically for SoFi. The case is then boosted by internal milestones, like that billion-dollar equity position.
And it all culminates in the big one, S&P 500 inclusion.
which the sources are framing as this inevitable event that triggers all that forced institutional buying. And the timing for all of this, they're really pointing to a great 2026.
Yeah, this is the year the vision finally pays off.
So that leads to the final thought.
It does, and this is the strategic question for you to really think about. If you accept the analysis, if you believe this inclusion and the monumental growth are coming, how do you navigate that?
Right, the classic buy the rumor, sell the news prong.
Exactly. How much of this is already priced in? How do you separate the real mechanical buying pressure from the short-term hype? The sources give a clue, I think. They urge you to stay excited, stay focused.
Implying what?
Implying that patience is the key. That success here isn't about perfectly timing the announcement spike, but about being positioned for the long-term re-rating that comes after. It's about building, not chasing.